Good afternoon, everyone. Thank you very much for joining us for today's Betashares webinar. Today's webinar is an advisor-only webinar. We're going to be talking about gearing strategies that you can use with your clients. My name's Cameron Gleeson. I'm Senior Investment Strategist at Betashares, and I'm joined by two gentlemen. Next to me, Jason Petersen. He's Partner and Head of Advice at Five Financial. And on the far side, we've got Ed Shilland, who is a Senior Advisor and Head of Investments at Genesis Financial Partners. Guys, thanks for joining us today.
Thanks, Cameron. Good to be here.
Great. So today we're going to talk to these guys about how they use gearing with clients, the value it can add, what to look out for, what are some of the pitfalls. We'll also get the opportunity to talk about some of Betashares' range of geared funds. As you may be aware, our first geared ETFs were launched over 10 years ago. So we've got history in this part of the market in terms of the product solutions. I think this will be a really interesting discussion, guys. So I'm really looking forward to it. Now, of course, with all of these presentations, I should say everything that we go through today should be considered general in nature. The obligatory disclaimer is on screen. Obviously, everyone on the call is advisors, so please seek financial advice before delving into any sort of investment decisions. Now, with the formalities out of the way, I think it's probably just time to just dive straight in. So maybe Jason, I'll turn to you to start with. Why would you use gearing in a client portfolio?
Cameron, we use gearing as with any other investment or any other product, any other strategy. It's really to fulfill a need, and a lot of it we talk about the gap analysis. What does the client need? Gearing can fill a really good part of the client's overall structure to get closer to where they need to be. It's a powerful way of doing it.
Yep. Ed, any sort of thoughts from you? Or
we're the same. We like to use the power of compounding.
Yeah.
Gearing allows us to do it as early as possible. So yeah, great tool to use.
Yeah. I mean, one of the things that I think is actually pretty interesting when you look at investing and you look at things like inflation and you look at tax. If we think about, say, for example, investing in a term deposit, I think right now you can get a term deposit, 1 year term deposit for about 4.7%, which kind of sounds pretty good. But then when you factor in inflation, which has been between sort of 3.5% and 4%, and then you factor in tax, and some people are paying up to 47 cents in the dollar in tax, a lot of investment strategies and a lot of ways that you can invest you're actually moving backwards in terms of even the level of assets and the pricing power of your wealth. And it is interesting, the use of gearing and the way that tax interacts with gearing. I mean, the fact that you can, rather than paying tax on interest earned, use interest that you pay as a tax deduction to invest in more, so shall we say, tax efficient assets, makes gearing quite a powerful tool and really can change the game for those that can, weather, if you like, some of the maybe additional volatility that comes with gearing. So I think it's a very powerful tool when you think about the overall landscape with inflation and tax myself. So just, I know that, we talked a bit about this off air, but, most Australians are very familiar with using gearing in property, residential property. Ed, maybe I just sort of turn to you. When you're talking to clients who may be familiar with using gearing within residential property and building a property portfolio, can you tell us how your conversation goes when you turn to, say, the equity market and what you might be able to do there, incorporating gearing within your stock portfolio?
Certainly. Normally the conversation is, why do you want to gear into property? And they go, it's easy to understand. It's a simple asset we all own. And then you go, well, would you consider equities if you could do get the same outcomes? And the answer is, oh, how? And the idea is for us to educate them on that and explain you have the ability to choose the leverage you want to get into gearing in equities and how that facilitates more strategy-based conversation and goals. So a lot of our clients, when they hear that, they smile because they know they've got other options available to them.
Yeah, that's true, isn't it? It's the ability to give them more than maybe what they've walked in off the street with and assumed is the only way to gear.
What they're used to, absolutely.
Yeah. Jason, how have your conversations gone in terms of the use of gearing?
Really interesting, Cameron, because a lot of people have already experienced at some point, well, just about, most adult Australians, a lot of them have experienced gearing by buying their own home.
Yeah.
And borrow 80, 90% of buying their own home, pay a lot of money in stamp duty to start with. And I think it's a lack of awareness in the ability to gear. And people hear the word gearing and they get nervous, but not knowing that already I'm heavily geared into my property.
That's right.
And I'm paying a lot of money to be in that property. And I think you've got a combination of gearing and you've got shares. Shares, and everyone's heard the perennial story of being risky. But we talk to clients about, you live in a property. Now, you cannot live in that property without the support of shares.
Yeah.
Everything you do, where did you get your loan from? The banks, for starters. I'm insuring the place, et cetera, et cetera. So when you turn the conversation to something that people really understand, all of a sudden it's not so scary. And then you add that gearing element to it and work through that, explain that, how it can be highly effective in their situation. It's quite powerful.
Yeah, yeah. Yeah, we also find with, I guess the ability really to access liquidity and have a great degree of diversification versus property are key benefits for, when you are using gearing, having those sort of levers you can pull is really powerful.
Absolutely.
Yeah. So I should say to everyone listening, you are listening to the go-to webinars widget. You can see a little space there where you can punch in your questions. So as we go along, we'll endeavour to take a few audience questions and make this interactive. These guys are, I think, really good representatives in terms of the value of advice. And I think we'll talk a bit about this, the value of advice when you're talking about gearing. But in that, maybe just to take, the simple perspective of asset allocation. There's sometimes this sort of view that a way to asset allocate over your life is to take what's known as an age-based glide path, where when you're young, you start off with most of your assets in growth assets like equities, and then as you mature, as you get older, you get into pension, you glide back down into defensive assets with very little equities. Maybe just I'll throw it to Ed to start with. I mean, do you agree with that philosophy? Do you think that's a sensible approach?
I think the philosophy works based on a set of data that now we're living longer. So,
yeah.
The black and white was it did probably work a couple of decades ago, but we are living longer.
Yeah.
If you look at the example, if you retire at 60 with life expectancy of another 27 years, you're only not even a third. So to glide down without realizing that you still need to be at the heights doesn't make sense.
Yep.
It doesn't mean you don't need to educate the client to go, really, we are long-term investors.
Yeah.
For very long term. And that's where gearing needs to be discussed to consider that.
Mm-hmm. Yeah, and it's really, it's matching those long-term liabilities to your assets, and that's what essentially it's about. And it's very individual. Every client's going to be different, and lifestyles are going to be different. So all of a sudden we have this rule that we've got to be age-based into your bonds. Really, that's again, it's a rule of thumb, but it's a very, very individual circumstance that we're dealing with every single client. So we need these tools. Potentially, I can have more risk or less risk, should I say, by gearing, if you like. I can take only half of my risk budget and then gear it, but I've then got effectively a lot more in my fixed interest defensive bucket. So there's some really powerful tools there, and I don't have to follow that rule that, yes, if I'm 70 years old, I've got to have 70% in bonds. I could have 30 years left.
It's true.
And I've got some serious risk of running out of money.
Yeah.
It does raise the point of the definition of risk. Volatility is a massive factor, almost too skewed, but that's a short-term risk versus the longevity risk. And you need to balance that out. When you speak to a client, you're like, well, what risk makes sense at this point in time, but how do we construct it all to build all weather when possible?
I think you raise a really good point there. The importance of thinking about that longevity, the risk of losing or running out of money is real for a lot of investors, and that's how taking some calculated risk through gearing can actually help. We almost think of, say, your asset allocation being maxed at 100% equities. That's really an artificial bound. You can, as a young investor, if you have the risk tolerance, use gearing to get more than 100% allocation to equities and grow that wealth over the longer term. What about, maybe just to take that back end, we talk a bit about sort of people who are close to the end of their life, that they should be in more defensive assets. Does that make sense? Is that always the case? That's, someone who's later in life should be, trending down towards more defensive allocations?
No, coming back to what we talked about a moment ago, that longevity risk is, I could be 70, I still have 30 years to go.
Yeah. If
I'm in defensive, I'm going to run out of money, or I'm not necessarily going to run out of money, I'm going to run out of lifestyle.
Yep.
That becomes key again. Every client's going to be different, so I'm tailoring everything I do to that client. So if I need to take on more equity risk, if you like, I will.
Yeah. We often see actually sort of advisors who will have a client that has more money that can cover the entirety of their requirements the rest of their life. And in some ways, they're really custodians of wealth, which will be passed on to the next generation. And once you start thinking about your investment time frame not being your own life but your kid's life, it does increase the amount of risk that you can arguably take. So that's also an interesting point there in terms of use of gearing at different life stages. Maybe if we could just delve into just a question as to when you've got clients, maybe talk about your own business if you can. Like, what are the types of clients that you see gearing to be a really applicable investment strategy?
I'll go first. Yeah, our typical client who sort of molds into a gearing strategy is we've got a young professional couple. Cash flow is driven by good earnings, but again absorbed by mortgage, private schools, and the like. And what they can and want to invest needs to go a long way. They're looking for the absolute, when they're sleeping, it's working harder. And so the conversations that often come to us as they've already had property is, can I leverage this? I still am 40, I've got multi-decades to go through. What are my options? But at a pace that I want to go at, we've already seen property is a lumpy asset. Do they want to remortgage again? Their aspirations are always family driven. They've got kids and they want to make sure, particularly private school, if they're going to private school, is guaranteed. How do they get into some form of strategy that will take those longer term goals into consideration and drive? So we introduce a gearing discussion, I think that's right, and then we talk to the client about behavior and how that pursues those needs and goals and objectives. And most of them, firstly, are really happy with the conversation starter, understanding that it's not an absolute magnitude of capital absorbed through debt, but it can be grown over time and expanded.
Yeah, the productive use of debt.
Yeah.
Jason?
Yeah, I've got a really interesting example of a 30-something-year-old that we've got probably 2 into the business. We've got the you call the emerging affluent, the 30-somethings, young family perhaps, or fresh into the good professional career, and then we've got the pre-retirees. But a 30-year-old that took 20% of their portfolio, let's say they got 150k in their super, if they put 20% of that into a geared strategy, by the time they're 60, they've got an extra $250,000 in their super. And that's just taking 20% of your balance and then contributing 20% thereafter. That's phenomenal. That's phenomenal. They're real life examples of what happens.
Like it's the ability to have more exposure to the market early and compound that over time.
Compounded tax benefits.
Especially in that super environment.
Phenomenal.
So, maybe just to sort of, think a little bit about those really good client examples. I really appreciate that. I thought maybe it might be worth just going through a couple of examples that we've got here in terms of gearing. These really do touch on some of what was described there, but just some simple examples to illustrate the power. So, Jason talked a little bit about the use of essentially a small amount of gearing within an SMSF. The ability of using gearing to increase the amount of income you can generate, and particularly franking credits. We see that one of the real benefits of gearing is the ability, if you're using gearing to access Australian equities, you can increase your income and franking. And obviously, if you're paying tax at a rate of 15% and getting franking, which is essentially a 30% tax credit, that can be really powerful for eliminating the need to pay tax within super.
Same thing. So I go to the other end of the spectrum. If I look at a lot of our 55 plus clients, a lot of them are not paying tax in their super where they're using these gearing strategies, because they're doubling up on the franking credits. Yes, there's a deductibility element to the gearing, so the borrowing is tax deductible. All of a sudden, you've got someone making 30k in contributions, 4.5k in contributions tax has gone by the use of these gearing strategies. And again, we're not talking large amounts of your portfolio.
It's incremental. We've got again, another example, and I think for young investors, this is particularly important. The fact that we've got these artificial caps as to what you can put into a favourable tax environment like super, $30,000 per year is your concessional contribution cap. If you were to use gearing, and this is just a simple example of using a 30% LVR to increase if you like that, the level of exposure up to $45,000. I don't know, Ed, if you have clients that are in this sort of situation using that in super, but I sort of think about it as almost a way of, increasing those contributions, but also because super, you're making them as regular contributions, you're kind of dollar cost averaging into the market, and takes away maybe some of the risk involved in gearing, because we know that, when you're constantly contributing, if there is a drawdown in markets, you're also buying when markets are falling. You're able to, if you like, glide your way back out of any drawdowns.
Yeah, the clients I tend to deal with, we're accumulators. We're buying assets and we're looking to buy every day. And superannuation contributions go into that environment, and they're buying.
Yeah.
So would you want to buy more assets at a lower value now or in 30 years' time?
Yep.
And the answer is I don't want to buy it in 30 years' time. I want to buy as much now. So gearing makes perfect sense, and continually growing that base. If we look at essentially, the capital as a pyramid, and the bigger the base, the larger the pyramid, and gearing provides us with that base. And so if you start that early, you can look at a larger pool of capital, and then options at that point in time when you need that capital.
Yeah. Giving people optionality. We've also got I think most people will be quite familiar with this scenario, but you've got a client who's got a mortgage, who's also still holding on to some shares. They've got a share portfolio, their mortgage, their principal place of residence, non-deductible debt.
Yeah.
It's actually interesting when you look at what level of interest you could afford to pay on that equity portfolio and still be better off than holding non-deductible debt. And I know we've talked a bit about this sort of approach and making sure people are being really optimal with their capital. That can be a real value additive conversation with clients.
Yeah, it's really looking at, as you say, where your capital is. So if I've got money sitting outside and even invested, I'm far better off taking that, ideally paying down the home loan. Yeah. You drawing from the home loan is one option, and using that to gear into a portfolio.
Yep.
That's powerful, because all of a sudden I'm turning that home loan debt that's at the moment 6%. It's effectively depending on marginal tax rate. I'm taking that as low as 3 and a little bit percent through that gearing strategy.
Yeah.
And if I'm sensible in the way I do that, it just compounds. And again, I can start drawing from that portfolio over time, paying down the home loan a lot quicker. So the power of gearing can't be understated. Use wisely, of course. The caveat there.
So I've got a this one is perhaps a little bit more complicated in terms of investment strategy, but this is just an example of a client or a couple who are in pension phase, and it is an area where people are probably less familiar with the uses of gearing. This particular portfolio, we've got a couple with $400,000 in property. They've got $150,000 in cash, and they've got $300,000 in Australian equities. Now, we know when you're in pension, there are certain things you can do to say, for example, improve your situation in terms of the amount of pension you can receive. And one way to do that is to use something which reduces the amount of assets that are evaluated against you in the pension asset test. So as an example, if this investor was to take the $300,000 they've got invested in Australian equities, reduce the amount of capital dedicated to that by using gearing. So basically sell out of $100,000 their Australian equities and put $250,000 into a lifetime annuity, which is eligible for a deduction of the assets which we use to test your pension asset test. You can actually see an increase to your pension payments of around about $8,000 a year. Now, if you've got a low rate of gearing on the Australian equity portfolio, that effectively becomes self-funding. So it's a way of maintaining $300,000 worth of exposure to Australian equities, increasing the amount of pension you can get, and maintaining the overall asset allocation. So it's perhaps a little bit more, complex in terms of a way of use of gearing, but I just think about all those different levers you can pull, and having an advisor who can help someone understand the complexity of these strategies is obviously critically important. I know we talked also about, and this might be another strategy which is a little bit more complex there, but we talked about the use of bucket companies, and some of the clients that you deal with that perhaps are looking to stop working before they reach 60, so they can't necessarily access the SMSF. Did you want to sort of elaborate on that sort of strategy?
Yes, certainly. So our clients, they always ask, what are the levers for superannuation, and you tell them when they can touch, and it tends to be going that long. And so they're looking for a structure that complements that large pool of capital they're trying to build in that environment. And often the case is the strategy comes out to have a bucket company, but then the magnitude kicks in of how big do we need this capital to come, and these companies start to be very small in capital size at the start, and you're really going, well, again, it's only going to have 40,000, that's not worth it. But with the concept of gearing, you can then start to magnitude that mental conception of, oh, it's actually potentially 80,000 in the market this year, and then we dollar cost average again, it moves to 160 and so forth. So the power of that strategy becomes really meaningful to these clients who inherently are working very hard, but understand time is, you know, what they want to get back, and trying to use leverage to gain time back, which is really important. And that's what we want to firstly educate them on, how we can do it, but with good strategy. That only comes from advice. This is not easy to design. It's not easy to apply either, behaviorally wise.
Yeah. I mean, that probably is a good segue. I mean, we should talk a little bit about the risks of gearing. You know, gearing inherently comes with a greater degree of leverage to the underlying asset, whatever you're investing in. Perhaps, I don't know, Jason, could you talk us through how you think about the risks to gearing, and how do you look to mitigate those risks?
Yeah, I think one of the keys with, and it's with any strategy, it's how much you put in there. You know, obviously, you go through 100% of your whole budget in there, you got problems. You know, it's being able to deal with interest rate risk. Interest rates rise, as we've seen, sometimes unexpectedly. So that's going to be a key component. So being able to meet those interest costs, and we've seen with the margin lending argument, you go back to the GFC where people were heavily geared and couldn't meet their interest costs, so they had to sell their portfolios at the worst possible time. So one of the things we're very focused on whenever we introduce gearing to mitigate that risk in particular, and the drawdowns, is have a bucket aside that Ed spoke about. You can top up, you can dollar cost average back in at the worst possible time. As though when I say the worst possible time, when the market's at its lowest ebb, you're buying things on special. You know, but it's having that capability is really, really important. And people can get too excited about gearing because it can be brilliant, absolutely brilliant. You get too excited and you're going to get yourself in trouble. So, you know, mitigating against that interest rate risk and liquidity risk, being able to get back in there and buy things at the right time.
Yeah. Ed?
We probably found two risks, and the first one is clients saying they will act in a certain way when markets deteriorate, and then they don't. You know, so you ask them, you know, what happened in, COVID, you know, when the market fell 40%, what was your behavior? And inherently they're like, well, we did nothing because we were worried about our job security and so forth. And then the portfolio rebalanced up and so forth. So a big part of our risk mitigation is, what will your behavior be based on your conditioning? And that's important. And essentially a big focus of our risk management is that. The other thing is with gearing is, gearing evolves. There is so many new products and structures out there, and inherently our partners come to us and go, oh, my friend's doing this and structured that way, and then we go, well, that's nice in principle but not suitable for you. So the structuring part and the right tool in gearing has to suit them as a unique individual.
There can be a lot of complexity with regard to certain structures, particularly if you need something that's going to be compliant in super. And we also see, you know, the costs can really vary in terms of what's the interest cost of gearing. To my mind, that's a major, you know, input into your decision. Is, you know, we think fundamentally about gearing. What do I need the underlying asset to deliver in terms of returns before my geared investment exposure outperforms my ungeared investment exposure? Well, that level is effectively your interest cost. So making sure that you've got some sort of investment solution where you're keeping that interest cost as low as possible, I think it's really critical. It might be time, I think it's worth maybe talking a little bit about some of our geared ETFs, because gentlemen on screen are you know, fantastic client supporters of our funds and really appreciate that level of support. So Betashares has been a product provider in terms of geared ETFs for over 10 years. Our first geared ETF was Gear, which provides geared exposure to the Australian equity market. We followed that up with GGUS. If we look at a geared ETF, there's some pretty, I think, you know, compelling advantages to using these products. Firstly, the gearing is internally managed within the ETF, and you know, we know that applying for any sort of loan facility can be painful. There's credit tests. There's also the risk of margin call and the need to sort of manage that, which obviously, you know, if you have an advisor, you can obviously, that can certainly help, but there's still a lot of administration around that process. having a internally geared ETF avoids the need for the investor to reach into their own pocket to fund that margin call. But also really critically, I talked a little bit about the interest cost. These funds are accessing interest rates, which I would describe as institutional interest rates. So it's Betashares arranging the gearing, it's not the end investor. And that means that you're getting very, very sharp interest costs. And that's really that driver as to how gearing can outperform, is lowering that interest cost. So the two funds sort of shown there on screen, Gear, broad exposure to the ASX 200, available with an LVR of between 50 and 65%, and on a daily basis. That's a pretty effective way to get leverage exposure to the Australian market. You're getting around about 2 to nearly 3 times exposure to daily movements in the market. Then we've got GGUS, which is the same exposure but broad market US equities. I'll just briefly show you a chart of these two funds because they have been around for a long, long time. You can see the performance. GGUS shown at the left of screen there. That's showing that versus the S&P 500. Now we know the S&P 500 has performed very strongly over the 10-year period. GGUS, its performance has well and truly outstripped that. It's been one of the best performing equity funds available in Australia, both global equities and Australian equities. It's important to note though, it comes with an increased degree of volatility. We can see the degree of drawdown in periods when the market's sold off. But if you're like not trading, and Ed talked about, you're taking a disciplined approach and continuing to dollar cost average, that can be quite an effective strategy. And I guess the point of using gearing, one of the points is having the right sort of mindset and the right sort of time horizon to know that markets can draw back, having a way of addressing that risk, and then a long-term belief that markets will outperform over time or produce positive returns over time. Now, I should say, Gear shown there, the returns actually don't include the franking credits. So when you include the extra franking credits you get, Gear has outperformed broad Australian equities by a long degree as well. Another way of sort of showing these returns is to compare them against the available funds that Australians could use. So there are around about 6,000 what are called global equity funds, both ETFs and managed funds. This shows the distribution of those funds in terms of their returns. The chart on the left-hand side shows those global funds. The blue line is effectively a MSCI World. You can think of that as your pass mark. And we know that unfortunately most funds underperform broad market indices. Gear has been one of the top performing funds. It's the fifth best performing fund out of that group of 600. I think it's just beaten NDQ, our NASDAQ 100 fund. Gear also outperforming the majority of funds. There are a number of funds that have, in fact, done slightly better than Gear. A lot of them are actually micro-cap Australian equity funds, so quite high volatility funds themselves. That Gear return, that doesn't, again, include the franking credits, which are about 2.5 to nearly 3% per annum in franking credits. So these are funds that really are in their sort of top 10 or top 15% of funds in their peer group. So they produce very strong results. But it's important to note, I guess, the degree of volatility that comes with what we describe as more highly geared exposures. Jason, I know you're a supporter of these funds. Maybe did you want to sort of talk to us a bit about how you use them with client portfolios? And
yeah, so we use both of them, and I'll tell you a very, very funny story very quickly. We had one client that bought into GGUS just after COVID. His concerns now that he's got significant capital gains tax issues to deal with. It's quite amusing. So.
Terrible place to be.
terrible place to be. But we use it a lot in super, particularly Gear we use in super. Now, one of the good things about this, you don't have to have an SMSF to be able to use these products in super. Right? So it's a limited recourse loan, which is the rules within super, but you're buying these on the market. It's a simple listed product.
Yeah.
So I can buy these on the market and get that geared exposure. In retail super, depending on which retail super you're in, but I can do that. So I don't have to have an SMSF to get the geared exposure. That's with both Gear and GGUS, so it doesn't really matter. Young accumulators, if I call it, a 30-year-old, phenomenal. You take your equity exposure, and as long as you've got time, which that's the expectation, obviously it's client by client, as long as you've got that time, these things are incredibly valuable. But de-risking through that, Ed spoke about that dollar cost averaging, putting continually to grow regardless of where the market is. It avoids the real risk with drawdown and just sitting there and waiting for something to happen. So that's a really good way of using it.
Yeah. So just to also, I think we should just, we should introduce our new funds, our Wealth Builder funds. If you can see on screen, the Wealth Builder funds shown here, these funds we launched in April this year. And I think the GGUS and GEAR provide really powerful tools for that, what I describe as a relative high degree of exposure or leverage to markets. But I think that these Wealth Builder funds are also special in their own regard. We actually launched these funds off the back of some feedback from a Betashares investor who wanted a more moderately geared exposure to diversified Australian and global equities. So we launched both G200, which is shown in the middle column, and GHHF. So G200 really is if you like, a geared version of our A200 fund. So it's that broad Australian market exposure. GHHF is a diversified all-in-one exposure to both global and Australian equities. Now, these funds have a lower level of leverage. So their LVR is between 30 and 40%. And what that means is you're typically seeing exposure to the underlying assets of around about 1.5 times, which, while isn't as, if you like, impactful as having something like GHHF, it does also mean that you don't need to be as watchful of the portfolio. You perhaps don't need to be, as concerned about what actions you're going to take to mitigate a drawdown. And if we show, I think everyone who's on this call will get access to the slides afterwards. We've done some analysis in terms of looking at and this is, I should say, this is simulated or back-tested returns, but we looked at how a moderately geared exposure to Australian equity markets and global equity markets would perform over a long-term period. And we found that at this level of leverage, that we saw, very strong results. So this shows in grey the ungeared exposure to that global and Australian equities versus what we describe as a moderately geared exposure to the global and Australian equities. And we've taken into account all costs of those two approaches. What we tend to find is very consistent outperformance in what's been a generally rising market. We do see periods of drawdown, and the geared exposures do suffer from slightly longer drawdowns, but tend to recover, or if you like, the time that they're underwater is about the same as a broad market. And we can sort of talk a bit about this. The period which you're in drawdown often is like one of the key risks that investors will look at, and knowing that your investment stands a good chance of recovering almost at the same date as the broad market, I think is pretty powerful. I don't know, do you sort of see applicability for these sorts of slightly more moderately geared exposures with clients?
Certainly, yeah. The clients, inherently we ask how much leverage, will blow this thing up. And these products, through the design and the R&D development, allow that leverage to be in some way optimal. And we apply them through our portfolios as a real diversifier as well. We can spread the risk because we can actually allocate capital in smaller chunks, but get the same overall exposure, which is naturally the younger people want to make sure that they're invested in all moving things going up. And these two products, particularly for us, allow us that ability to, again, diversify well, but use leverage to even diversify even more so, which is really important.
Yeah, so spot on. So these two funds, I mean, if we look at the degree of uplift, we typically say, this is one point about gearing, is that on a daily basis, we expect that you're going to see a exposure to the underlying asset of between about 1.4 to 1.7 times the performance of the underlying asset. What we've sort of seen here is over very long periods that the overall uplift in terms of your returns works out to be around about that level, about 1.5 times over very long-term periods. It can vary, there's compounding, there's interest costs and things that will mean that will deviate over periods, but generally speaking, very consistent, delivery of that leverage exposure due to that level of gearing. I think it'd be quite effective. And as a result, if we look over all 7-year timeframes across that period, rolling 7-year timeframes, the geared exposure, in fact, outperformed the ungeared exposure every time. So that we think is a very compelling offering. So, I mean, just to maybe talk about that risk point, it's really important to acknowledge the additional risk with gearing, but the other element, or the other way you can deal with the extra volatility that comes with gearing, is diversification. And the slide that we've got here compares on the far right-hand side I'll call it a typical SMSF portfolio for a client who might be quite concentrated. It includes the 6 most popular ASX listed stocks in a portfolio. You all know the names, and we show the volatility, but also the drawdown of that portfolio during COVID. So having a concentrated portfolio, whether it be via margin loan or even just a direct stock portfolio without gearing, can be quite volatile. If you're using gearing, using a diversified approach reduces the chance of that gap risk that we see with single names. So we see that the drawdown characteristics of a moderately geared exposure, both Australian equities or global equities, actually looks pretty compelling. And while there is a slightly higher level of volatility than an ungeared exposure, I think diversification can be a really good tool to use when you are looking to access, geared equity investments. Right, so I think I'll we'll go through a few audience questions now, if I may. Okay, so we've got one question here. The first question in here comes in about, can you talk us through the process of rebalancing these ETFs? So essentially, if we think about our moderately geared ETFs, they have an LVR between 30 and 40%. The way that the fund works is on any single day, the underlying stock portfolio will vary. And if the LVR creeps up to above 40% or falls below 30% because of market movements, we'll rebalance to the midpoint of that gearing range. Now, when you're talking about that rebalance characteristic, this is really important for ensuring that you've got true exposure as defined by the product. But it really does dive into the second question where someone's asking about price dependency, path dependency with regard to geared funds. Now, where you have a trending market, both up or down, that rebalancing actually helps you in terms of your exposure. Where we saw the COVID sell-off, the rebalancing of the geared funds meant that you didn't suffer the same loss as if you hadn't rebalanced. But rebalancing can work both ways. If you have a market then rebounds after a rebalance, that if you like, that rebalancing can work against you. The great thing about the moderately geared funds is that because the gearing range is much narrower and the amount of rebalancing that needs to occur is much smaller, we tend to see less, if you like, path dependency. And I think that's a really strong point on those funds. GGUS and gear can have a lot more of that path dependency, and at times that can work against you. It can certainly work for you, but it can work against you in a market that trends in one direction and then changes direction. But for the moderately geared funds, we tend to see that there's very little path dependency or volatility decay, as someone's asked there. Next question is, what are the major platforms here in G200 can be accessed for super? We'll get someone to come back to you with the answer for that. What are the current borrowing interest rates for these funds? So the funds themselves that we offer all access really attractive rates of interest. Because Betashares is an institution, can access institutional borrowing rates. The funds themselves, like the rates of interest are incredibly competitive. We're actually subject to a non-disclosure agreement with the institution who we borrow off, so I can't disclose the actual rate. But suffice to say, if you look at a margin lending rate, which is say around about 9%, you're talking about a saving of potential of greater than 300 basis points in terms of the interest rate. So they're incredibly attractive rates. You will most likely find that the rate of interest that these funds pay is lower than what an individual could access any sort of investment loan to borrow to buy property or to buy shares. And keeping that interest cost low is really important. Maybe just another question here. I'll pose it to either of you guys. But in terms of, when you're managing a client that's say using one of these funds, how often do you need to sort of adjust their level of leverage, or what's your sort of approach to that?
So there's two events really. So we have a quarterly rebalance across the portfolio. So let's say I've got gear in my portfolio, and that's my Australian exposure, but I'm using it in a geared way. So let's say my allocation is 30%. If that plus or minus 5%, I will bring it back to 30%.
Yep.
So that does two things. One, it takes advantage of upside. So I'm actually taking some profits instead of just waiting until it hits the top of the market. Secondly, I'm able to buy when it's low. So bring it back, I'm taking advantage of that as well. So that whole drawdown risk, I'm actually, through that regular rebalancing, I can overcome that to an extent.
Yeah, great.
We have a similar discipline, rebalancing is essential to manage the risk, and also buy when it's low, which is the hard tool to do while you go forward. But yeah, essentially we do the similar process.
Yeah, great. All right, great. So I think I'll just maybe just to share the obligatory disclaimer slide here. I just want to ask one question in closing. There's a few more questions that have come through on the line, but we'll endeavour to have someone come back to you here. Of course, important to consider the risk again. We did talk a little bit about the risks, about ways that you can potentially mitigate some of the risk, but ultimately there is a degree of risk you are taking with gearing. It's important to think about that risk and size the positions appropriately. And I think this really does talk to the importance of advice when you're looking to use gearing. I mean, clearly you guys are believers in the value of advice and really what you can do to add value to clients in this regard. Jason, I just ask of you that question. Like when you have these conversations with clients, I assume that they are very grateful for what you're able to provide there.
Absolutely, and you see it in the results and year on year. And we're not talking that it's not all about the outperformance. Yes, over time it's going to outperform, but it's just the tax benefits that are automatic. They're instant. You see them all the time. Yeah. Particularly, say, super funds that aren't paying tax. Show me how many super funds don't pay tax, unless you're in pension phase, of course. But how many super funds are not paying tax?
Yeah,
I've got a lot of them.
Yeah. And I mean, Ed, we talked about your clients. A lot of them are sort of professionals in the prime of their career, time poor. It must be really, advantageous for them to have an advisor who can sort of keep their hands on the steering wheel with regards to this sort of stuff.
Yeah, I think navigation is key. They are steering, but the navigators are always on watch, and always understanding what the weather conditions are doing. And they like it. It's positive in nature because the world moves very quickly, capital markets move very quickly, debt moves very quickly. And it all ties it back to their strategy and as an individual. So very much appreciative of that navigation, and the education as well all the time. So it's really important, particularly on these strategies.
Yeah. I'd like to, just on behalf of Betashares, I'd like to thank Jason and Ed for coming on today. We've had a chat before, and I think it's been a really interesting conversation for me, and we're really grateful for them to spend the time. We hope you've enjoyed today's discussion as well. We also would like to just thank everyone for their support of Betashares over the years. We couldn't be where we are today without the support of advisors across Australia, and really appreciate the support you have for our products and for dialing in today. Thank you very much, everyone. Have a good day.